Thank you all for joining us for this monthly macro webinar for December 2023. Let's get started. I think the biggest thing to recognize for the US economy and really for the global economy is over the last month since we last got together, there has been a significant easing that has occurred in the context of a very late cycle environment. And so when you look at what's going on in the US economy to start, what do we see? We still see secularly low unemployment conditions. We see nominal growth that continues to be relatively elevated compared to what's appropriate for the Fed's mandate. And we've seen in the most recent period, really since the announcement of the November QRA announcement, a significant financial easing. Now, we've long talked about how this hot economy requires higher interest rates, lower stock prices in order to kick off a process that would sufficiently loosen labor markets, bring down wage growth, and allow the Fed to meet its mandate. And what happened on November 1st is we took a relatively substantial step back by the Treasury announcing that they would have much less issuance than what was expected. The response to that was a relatively significant bond yield move downward. And coincident with that was an equity move upward. And so what we've seen over the course of the last 35 days is basically a total and complete unwind of the tightening dynamics that had existed in the previous couple of months. And that's really what you see here in this chart. This is the Goldman Sachs Financial Conditions Index. You could pick a bunch of different indexes. It doesn't really matter. What we've basically seen is a complete reversal. And so while we were talking about we were a complete reversal to where we were over the summer. And so in the summer, we were having a conversation about how the US economy was running too hot and needed tighter conditions in order to slow the economy, in order for the Fed to meet its mandate. It looked like we were on that path that would get us in that direction. And that's basically totally reversed. And in many ways has reversed more than I think most people would have expected, given the magnitude of the policy announcements that occurred in early November. So we've taken a step back. You can see that across asset markets, where basically everything that happened from the summer until Halloween has reversed. You can see in the upper right-hand chart, the upper left-hand chart, that the stock market is basically back to highs, nearby highs, and only 5% off of all-time highs on a total return basis. The two-year rate has fallen considerably from well above 5 into the mid-4s. You see the 10-year rate, which peaked right at 5, has fallen down into the low 4s. We've seen almost 90 basis points of long end easing as a function of this. And the term premium, which had finally started to rise going into this period, has now, reversed basically most of that recent rise, and we're left back with where we started. And in the context, there's a lot of times when an easing like this would be appropriate for an economy, particularly if the economy was running slow. But that's not the situation where the US economy is sitting right now. We're in a late cycle environment and nominal growth is too strong. Maybe not quite as strong as what the third quarter GDP print was, well above 8%. But even nominal growth in the 5 to 6% range is going to meaningfully outstrip the productive capacity growth of the economy plus the mediocre labor force growth. So you don't need anything like what we saw in the third quarter to continue to put pressure on wages and prices through the economy. At this point, as a function of the significant shifts that have occurred in market pricing, there is a significant easing priced into the short rate market for 2024. I think this chart gives you sort of a good sense of the actual distribution that's priced into the market. And what you see right now is the first cuts are starting to get priced in for January. And then on top of it, if you look at the curve or the distribution of plausible outcomes, we see that there's a 33% chance pricing 100 basis points of cuts by June, and a roughly similar probability of almost 200 basis points of cuts, of 200 basis points of cuts priced in by December. The median point now by the end of December is somewhere between 5 and 6 cuts based upon the market pricing. Now, that is a pretty extraordinary easing that's expected in the short rate market in the context of an economy that just printed an 8% nominal GDP growth measure in the previous quarter, and that has secularly low unemployment conditions. And I think a lot of what's going on in terms of the macro environment is it's really predicated, that set of pricing is really predicated on the expectation, A, that inflation is fully beat, and B, that we're going to have a situation where the Fed is going to respond to the inflationary dynamics by cutting interest rates relatively aggressively in order to maintain real rates in the way that they see it. Now, that may happen or it may not happen, but those are the two expectations that are essentially priced into the market the way that the pricing is right now. Inflation is beat, and the Fed is going to be highly responsive to that circumstance by cutting interest rates. We'll talk a little bit more about that later, but it's important to keep that in mind. I go back to this. I know I've started a few webinars the last couple of months with this ordering, but I think the ordering is really important to recognize once again. How do we get from an economy that is running hot to an economy that has slowed sufficiently in order to moderate inflationary pressures? It isn't magic. It takes steps. Those steps, the steps that are required, are that interest rates need to rise, which then creates falling of equity prices, which then creates slowing demand, which then flows through to earnings declines, labor market weakness, wage growth moderation, and finally getting to that point of inflation falling durably to the Fed's mandate. If we look at this ordering, we've basically set ourselves back almost 6 months in terms of how this is playing out as the tightening of financial conditions, which were starting to move us on this path, right, with the rise in bond yields and the decline in equity prices, that is all reversed. And instead, we're back to a situation, we're back to where we started over the summer. And in many ways, what we're seeing is an expectation that the Fed will be highly accommodating of this circumstance. Now, all of this easing that's priced in, as I said, is really very much predicated on falling inflation, that inflation is beat, and that the Waller cuts, as I like to call them, are the path that the Fed is going to pursue. Now, I'll mention and I'll highlight, in many ways, what's priced into the market right now in terms of the interest rate cuts that are priced in are consistent with the types of cuts that were outlined by Waller right before the most recent blackout period. That's important to recognize because it means that if you believe that the Fed is going to take that path is already fully priced in, that is already reflected in equity and bond markets. And so in order to believe that, in order to hold, to go, long short rates or long bonds at this point, you have to believe that there will be meaningfully more cuts than what is currently priced, because what is already priced is a perfect move of inflation to 2% and the Fed tracking that and maintaining a real rate, maintaining the existing real rate by cutting interest rates 150 basis points. So you have to believe that there's going to be something substantially greater than that amount of cuts in order to go long 2 years or long short rates like December 24 SOFRs right now. And that's not going to take just a fall in inflation. That's going to take relatively substantial weakening in growth. But before we get there, and I want to talk about that in a minute, before we get there, let's talk about this inflation picture. We have obviously seen inflation moderate relatively considerably over the course of the last, 6 or 9 months. And at this point, we've seen a couple of headline and core inflation prints, which are in the ballpark of what the Fed's mandate looks like. And many people will go ahead and put in all sorts of different slices and ways that if you take core or headline inflation over a moderate term, like 3 or 6 months, what it looks like is we're at or just above the Fed's mandate. And even more so, if you take certain market-based prices like apartment rents and things like that, we basically, there's an argument, a common argument, that basically inflation's beat, the Fed is done, they've met their mandate, there's nothing more to do. But I would pause on that point and really wrestle with the question of whether or not this economy and the U.S. economy has durably brought the inflation back down to 2%. And that durable point is such a critical component when both you're thinking about the path of monetary policy and as the Fed is thinking about what is the appropriate monetary policy for the economy. Because it's not about touching a 2% inflation target. It's about durably bringing inflation down to that 2% target. And I think some of the main concerns that the Fed and others have when it comes to thinking about that durable question is what we've seen over the course of the last year, really, and even more acutely over the last couple of months, is that inflation has come down, but it's come down driven by relatively significant disinflationary forces, which may not be able to be persistent. And so I highlight 2 charts here because I think they're 2 good indications of what has brought this inflation down, which you see it here on the left-hand side. In the middle chart, we've had a big fall in gas prices. First of all, the big fall of gas prices from $5 to $3 was a huge disinflationary impulse, which helped bring things down, in part driven by the SPR release and other dynamics going on. We've had another disinflationary move in gas prices over the last couple of weeks. That is the flow through of those weakening gas prices is a critical component of creating disinflationary forces in the economy, and certainly very critical to keeping that headline inflation number quite low. But gas prices will not fall forever. And that's the important thing to consider, because it's not about, is there a moment of 2% inflation? It's about whether this level of inflation can persist. And so it's highly dependent. What we're seeing today, the reports that we see today and over the course of the next couple of months, are highly dependent on a continued fall in oil prices, which very well may not happen. I'd also emphasize on the other side, which you see all the way on the right here, the fall in used car prices, which is a really important component of bringing disinflationary dynamics into goods prices. And again, that's fallen something like 15 or 20% on a year-over-year basis, has represented a big disinflationary impulse, and been a critical component of bringing the reported numbers down. But the question is, will that persist, and how long can that persist? Maybe it persists for the next 6 months, but will it persist in a way that durably brings inflation down to the 2% mandate over time? And at some point, there will be a natural bottoming of these used car prices. And we're probably not all that far away from that when you think about what the shifts in these prices have been in the context of overall price increases in the economy. I mean, for instance, overall price increases in the economy since the COVID began have been about 20%. So, used car prices being in line with that broader price pressure in the economy would probably fall to like 180. We're not that far away from that. And when that stops from deflating to being flat, it's going to take a huge disinflationary pressure out of the economy. The same story is true for things like airfares, which are oil dependent, and other things like that. And so that's where I think a lot of folks are sitting saying, I think, the resolution of the supply side has allowed us to create immaculate disinflation, and they've, to the Fed's mandate, and they've been right about that that's true in a measured sense and in a short-term sense. But the question is, will it persist? And it will only persist when those disinflationary pressures start to go back to sort of normal price growth, right? And you have all the other pressures in the economy start to keep price growth levels at 2%. And can that happen? And that's why you probably, for many of you who are following me regularly, are probably sick and tired of me talking about wages and how wages are critical to understanding what the structural drivers of inflation are. But that's why the wage conversation is so critically important, because once those disinflationary pressures wash out and move back closer to zero, what we'll be left with is nominal wage growth relative to nominal productivity growth in the economy. And that will determine what the structural inflationary pressures are. And when you look at what that picture looks like, we still have secularly tight labor markets. They're not moving much. They're not really deteriorating. And that is creating wage pressures in the economy. So that's what you see over here on the left-hand side, right? That 3.9% unemployment rate is, continuing to put pressure on wages. We see it in the ECI, which has stabilized at a level that's meaningfully higher than where it was pre-COVID. You see it in the Atlanta Fed wage growth tracker, which also has stabilized over, since August. The monthly numbers have stabilized since August, basically at that just about 5%. That's a couple percent above what the level of growth rate was pre-COVID. That's creating structural pressure in the economy. And until we see the labor markets meaningfully weaken, these pressures will remain in the economy. And so far, and I wrote a tweet about it earlier today, if you scan across all the different pressures in the economy, all the labor market pressures in the economy, what you see is that the labor market is just chopping sideways. Sure, we've had a bit of loosening that has existed over the course of the last 6 or 9 months. We went from a 2022 labor market that was screaming hot, almost unreasonably screaming hot, back to a labor market that is tight and tight on par with what we saw in 18 and 19 pre-COVID. But the difference today is in those nominal price expectations and the accumulated gap in real wage growth. And as a result, what we're likely to see is continued pressure on nominal wages at this level of unemployment. Just because we're at the same level of unemployment today as we were in 2018 and 2019 doesn't mean we'll get the same level of wage growth, right? Because of two important points. One is that the expectations of price increases today are radically different than they were 5 years ago. And number two is that the level of real wages continues to trail longer term norms. So we've basically had zero real wage growth over the course of the last 4 years. And that's important because as people are negotiating their wages, they still feel that pressure of being behind, both of which create a tight labor market. Those expectations are creating a situation where wage growth persists. Now, in addition to that, I'd emphasize that there are other things going on in the market that are that certainly raise questions about whether we're on the fast track to inflation being beat forever. One of the ones in the middle, the points that I show here in the middle, is that it's not clear that housing inflation is beat. On a level basis, rent CPI continues to trail the levels of asked for rents, here shown by Zillow, but across a number of different measures. And the BLS's favorite measure, which is the new tenant repeat rate, continues to be on a level basis relatively elevated in comparison to reported CPI rent, those two charts in the middle. And what that means is that even though you might be seeing printed or published rents at zero or slightly positive, it doesn't mean that CPI will come in that way anytime soon, because there still continues to be a level catch-up that needs to occur for the home ownership costs that get measured in CPI. And so the idea that everything is done, and this is not to mention the fact that now we have house prices rising on a like-for-like basis at almost 1% a month, which is continuing to put pressure on rental prices as well. You put that all together, it's certainly not clear that the rent problem is beat in the U.S. And then finally, I guess I touched on it briefly here, but it is particularly notable that we're seeing inflation expectations remain elevated at a time when they should be falling relatively significantly. Now, this should be giving the Fed a significant concern, because typically these inflation expectations move with oil prices. Oil prices come down a lot, people's inflation expectations moderate. But what we're seeing is a dynamic that we haven't seen in a very long time, which is that despite the fall in oil prices and gas prices, what we're seeing is that inflation expectations either remain elevated or actually rising modestly in the medium to longer term. And so what you're seeing here is that that's the problem. Like, that's the problem connected back to the wages, which is the Fed has not beat the inflationary dynamic that exists in the everyday consumer's minds. And therefore, to the extent that labor markets remain tight, right, as tight as they are today, you're going to continue to see that wage growth. And so this idea that what's going to happen is wage inflation's beat and we're all done, and there's nothing, wage inflation's beat, headline inflation's beat, the Fed's ready to cut a ton. It just doesn't line up with the evidence that you see if you think about the problem more holistically than just the reported numbers over the course of the last couple of months. And the Fed is thinking that way, and I think it's a big part of why Chairman Powell continuously over and over and over again keeps bringing up that the inflation is still not yet beat. A lot of folks along the way are pointing to the bond market rally and saying, hey, I actually think, bonds must know something. And if there's one thing we've learned over the course of the last couple of years is that the bond market may not be the smart money. I mean, how many times have we gone through this process where a massive amount of cuts get priced into the market? Remember, the short rate market priced in 4 cuts in March of 2023. The bond market and the short rate market priced in 4 cuts in 2023. Where are our 4 cuts? Right? Expectations that were totally inconsistent with how the economy played out, because the economy was much more resilient than folks expected. Similarly, we're basically seeing a repeat of that pattern, which is a whole lot of cuts are being expected. And then in many cases, what folks are doing is they're looking at the bond market and they're saying, look, bonds are rallying hard. They must be telling us something about what's going on. But I think what we're seeing today in many ways is a repeat, and a more extreme repeat, of what we saw in late 2022 that set ourselves up for a pretty big bond sell-off in the beginning of the year. And what that is we've had a big underperformance of long-term bonds relative to stocks over the course of the year. Long-term bonds through Thanksgiving were down about 25% relative to stocks. What that mechanically does is, for big institutional investors that have targets for stocks and bonds allocation, they must rebalance back into the underperforming asset. And they typically do that sometimes at quarter end, but almost always are doing that right there before the end of the year, but in that Thanksgiving period through the end of the year. And increasingly what we're seeing is that fast money hedge funds are recognizing that this is a typical dynamic and are in some ways front running the actual flows. And so what you saw in 2022, in late 2022, with that red line, which is Thanksgiving, noted, is after a period of some underperformance of bonds relative to stocks, you saw a pretty good bid for bonds for a few weeks through December 17th. And then what happened was the fast money sold it to the actual rebalancing, and bonds came back down. I think we're probably seeing a similar dynamic where but only at a larger scale, where the significant amount of underperformance of bonds is creating that short-term rebalancing, which is putting pressure on bonds and obfuscating the positive growth dynamics, the positive liquidity dynamics that have come from this easing, and showing up as a bond rally. Now, that can persist for so long, but my guess is we're going to start to see the pressures ease off of the bond market, and equities will outperform bonds as that rebalancing pressure starts to fade. And if anything, today is looked up like a bit of an example of that exact dynamic playing out. And that's where tactically, even though what we've seen is that this dynamic, which is this rebalancing dynamic, is really pushed hard on bonds. When we take a step back and look at the overall picture and we say, what does this economy look like? What are the sort of pressures, tactical pressures on asset prices right now? In many ways, they're in the opposite direction, right? The economy was running hot and got some tightening, which is now reversed. In many ways, has gotten a real easing. With stocks rallying the way that they have and interest rates falling the way that they have. That dynamic should be good for stocks and bad for bonds, as the economy on a forward-looking basis is getting a stimulative impulse. And if anything, it's actually getting a bigger stimulative impulse than it would otherwise get just from the market action, because we've had that fall in oil prices, which basically just translates straight into consumers' pockets and is a mini stimulus check for them as well. And so strong economy stimulus that has basically emerged over the last 6 weeks should lead to stocks outperforming bonds. In many ways, what we saw following, once the SVB thing sort of got washed through the market, we may in early 2024 see a repeat of what we saw in May through July in 2023, and also what we saw in early 2023 as well, before the SVB situation occurred. Because as you go back to this framework, when we're in the first part of this framework, which is where we are right now, remember, stocks should outperform bonds during an environment of higher for longer. And that's because of this ordering, which is first the bond yields rise and then the stocks fall. I think it's interesting, just taking a step back more globally, to look at the picture, including Europe, which I think is quite interesting. The European dynamics that are going on are totally different than what they are in the US. But what we're seeing is a situation where the pricing of cuts in Europe and the US are the same for 2024, despite the fact that economic conditions are radically different. And so what we see, first of all, is on the short end, real rates in Europe are now quite elevated. A big reason why that is because core inflation has been very soft, running basically at zero over the course of the last couple of months. We're seeing inflation measures, market-based inflation measures collapsing in Europe, reflecting the fact that the economies there are meaningfully deteriorating over the course of the last 3 or 6 months. But yet, we're seeing 150 basis points of easing in Europe at a time when, when the dynamics, 150 basis points of easing in Europe, which is the same amount of easing that's basically priced into the US curve. But there's a huge difference between economy shrinking and having zero inflation versus the US economy, which is at, where unemployment's at secular lows and growth is pretty strong, and we've gotten a big easing. Two radically different economies and circumstances pricing in essentially the same dynamics through the course of 2024. I think that's probably the divergence between the US and European economy and the policy divergences that we're likely to see through the course of 2024 are probably one of the more interesting cross-cutting global dynamics that we're likely to see. Now, I'm gonna, I've talked a fair amount up here about how the market environment favors stocks relative to bonds, given the tactical dynamics at play. I think I would be remiss if I didn't take a step back a little bit and talk, in many ways also about the strategic asset allocation dynamics that exist today. So any short-term tactical bet is only so good. Any one particular bet is something like 60-40 over a 1 month time frame. On a longer time frame, say 3 years, 5 years, 10 years, for most investors, what drives the outcomes of their portfolios, for those who are not tactically trading on a day-to-day basis, is valuations. And while in this moment, the dynamics look as though they favor stocks relative to bonds, you have to take a step back and at least acknowledge that on a longer term basis, equity-heavy portfolios are set to meaningfully underperform a more diversified portfolio from a strategic perspective, because the valuation dynamics have become so extraordinarily stretched when it comes to the value, the valuation of equities relative to other assets. Now, some of you who have been following us for a long time might be familiar with a strategic asset allocation portfolio that I developed and wrote about 9 months ago, which I call the simple game plan. The basic idea of the simple game plan is create a portfolio that is not so reliant on the secular disinflationary strong growth wave that we've seen in the US economy over the course of the last 40 years. So moving away from the 60-40 portfolio and recognizing that the biggest risk for investors is a situation in which assets underperform for an extended period of time and where inflation is elevated. The simple game plan portfolio, you can think about it basically broken up into two pieces. One piece is a long-term strategic portfolio. A beta portfolio is what we call it. That represents about 60% of the portfolio. And that is structured as a risk parity portfolio tilted towards commodity holdings, because the biggest risk for investors is inflation when it comes to their purchasing power. And on the other side, includes or increases the amount of tactical allocations in the portfolio to help navigate through challenging market environments, including a 20% allocation to manage futures or trend following, as well as a 20% allocation to balanced alpha strategies. That portfolio has what you see here is comparing the traditional 60-40 portfolio, which is highly dominated by stocks, compared to that simple game plan portfolio over the last few years. And what you see is that the continued relatively significant outperformance of U.S. stocks has meant that a much more diversified and agile portfolio hasn't outperformed a stock-heavy portfolio in the last 4 years. And the reason why that is because equity outcomes have been extreme relative to long-term history, whereas the returns of other assets have been quite modest relative to history. And so I think in a lot of ways, when you think about your sort of strategic portfolio, a prudent portfolio or prudent portfolio allocations in many ways have been the worst portfolios that you could have held for the last 15 years. But it doesn't mean that on a forward-looking basis, you should give up on diversification, because these sorts of dynamics that we've seen post-COVID and even since the GFC, they will not persist for forever. And just to give some context in terms of how extreme this is, when thinking about how whether you want to hold an equity overweight portfolio, the left-hand chart simply shows stock returns relative to trend versus the returns of all other assets relative to trend. Those two pieces are shown zoomed in on the right. And what you see is that stocks from a valuation perspective are at their highest level relative to all other financial assets, meaning bonds, credit, commodities, gold, etc., than they've been basically other than 2 other points in history. That is the peak of the tech bubble and 1929. And so when you think about building a strategic portfolio, and I should say, and the reason why that is a balance between the fact that equity returns, that's what you see on the right-hand side, shown in gold, are elevated. Those returns are elevated relative to history. But the important thing to recognize is that other asset prices and their returns are very low relative to history. And so the balance between those, the relative performance between those, it's what's creating such an incredible divergence in terms of stock valuation relative to all other assets. Can this persist? Like any value measure, of course it can persist, but there will be a day, there will be a time when the tightening cycle has played out sufficiently and where stocks will underperform other financial assets. And so the question as a longer term strategic asset allocator is whether or not you want to be overweight equities over the course of the next 3, 5, 10 years when the valuation divergences sit as extreme as they are today. So I'd emphasize, while in the short term, it does look like you want to favor stocks relative to bonds, and that is a tactical view that makes a lot of sense given the dynamics at play. A strategic asset allocation, which is what the vast majority of investors should be thinking about, should not be nearly as overweight stocks as they currently are today, given these longer term valuations. With that, I'll move it here to the audience questions. Thank you all for submitting them. And I'll try and run through as many as I can here in the time that we have available. I think a good question here, I'll run through a few of the pre-submitted questions. One question here, which is, what is the probability that the recession begins soon? And what I'd say to that is, I think it's pretty, in order for a recession to occur, you need a negative economic momentum and a meaningful tightening. And that's really what you want. You want to bring those 2 points together, right? Negative economic momentum, tightening, which then kicks off a process of slowing the economy and tilting it into recession, often a self-reinforcing process, right? That the negative economic trend starts to create weakness in asset prices, particularly stock prices, which then feeds back and creates the downward cycle. Stock prices today are reaching new highs. Bond yields haven't been this low in a long time, right? Housing conditions, mortgages, those cyclical dynamics are actually on the margin tilting up, not down, because of that stimulation. So when you look through the economy, consumer buying has actually picked up as a function of the lower oil prices and higher stock prices. Those are the sorts of dynamics that you typically would not see with a near immediate recession. Right? What you typically see is those things would have to be deteriorating for a period of time as the leading indicators of the economy, and you'd need to see the tightening dynamics playing out through the economy to get to recession. And so a lot of ways, I know probably a few months ago, we had one of these webinars, looked like the storm clouds were building. That was before there were almost 100 basis points of interest rate easing and more than 10% stock returns, 10% positive returns in stocks. That has set us back something like 6 months. The conditions look a lot like they are in the summer. We are starting to see actually the real world consequences of those decisions. And that's the sort of set of conditions that would not align with a recession that would occur over the next 3 to 6 months. Next question. Are we likely to see a yield curve normalizing at this point, with interest rates around 4? Another question here, which is, is it possible that the long-term interest rates fall even more than they are today? So what I think about in that question is what's priced in. What's priced in is 150 basis points of cuts in the near term and a zero term premium. And zero doesn't mean anything in particular. It's just a measure. It's a way to get a sense as to what the conditions look like. And so we basically, we have those cuts priced in. We've had a full reversal of the term premium. Both of those dynamics are at place. And if you're going to buy bonds or buy short rates in this environment, what you have to believe is that conditions will be meaningfully or conditions will be such that the Fed will have to do a lot more than currently priced in. The only way that I see that happening is if we have a relatively significant deterioration in growth, as well as a significant decline in stocks. And so, and as I just said, the economic momentum and the incremental tightening and easing would align with the conditions moving in the opposite direction. So what we're seeing, and this is very normal, which is in many ways it's a self-defeating process that we've seen a few times over the course of the last couple of years, where a bunch of easing gets priced in. That's stimulative to the economy, right? Which means that the dynamics that would have had to occur to engender that sort of weakening, that sort of easing, are actually feeling pressures in the opposite direction. And so that's really, I think, what we're going to see over the course of the next 3 to 6 months. So the odds that we're going to see rates get pushed lower from here in a meaningful way, I think the odds are skewed in the opposite direction, given the macroeconomic momentum and the incremental policy and market easing that we've seen. Let's hit a few of the questions that you folks, the few live questions that you folks have jumped in. The Fed and Chairman Powell, if you have questions, if you could chuck them into the question and answer tab thing, because it's going to be easier for me to look through them there. The Fed and Chairman Powell are well aware of the easing. I presume they are, if they look at the market. So why no pushback? Why let Waller go out and say what he said? I think two things. First of all, what's priced in the market is what Waller said. So you have to believe the Fed is going to be easier than what Waller said in terms of their policy path in December in order to buy, in 24 in order to buy those rates. So that's what you have to believe. Very important. If you're trading markets, that you're trading what's priced in. I think, we've gotten to this world of reading a bunch of tea leaves of what a variety of different folks said. Other Fed governors came out and said things that were inconsistent with what Waller said. I think in a lot of ways the market is really, focusing on a set of policy conversations or policy comments that are aligned in their best interest, combined with the fact of some of these shorter term dynamics that I highlighted that are driving bond yields down, as in the short term as a function of rebalancing pressure. But I wouldn't necessarily assume that just because one Fed governor says one thing and one Fed governor says the other, that it is necessarily the policy decisions or even the median policy expectation on a forward-looking basis. What I'd emphasize is focus on the macroeconomic linkages. The macroeconomic linkages show an economy that's doing pretty well, that's very late cycle, that's just got a bout of stimulation. And that is not the type of economy that will lead to a significant number of cuts. And just have in your mind, Chairman Powell, more than a year ago, said that the neutral rate of the economy was like 2.5%. So, and obviously did something totally different and has learned very differently what the actual neutral rate of the economy is. And so what I'd highlight, or he said 2.5% was tight, even tight at that time, right? Transitioning to tight policy. Just because they say things doesn't mean that's what their policy action is going to be. What they're going to do is focus on the macroeconomic data. And so honestly, we'd all be a lot better off if we just stopped listening to these folks as they're out there chattering around, giving conflicting signals, and instead just focused on the macroeconomics and what's likely to transpire. I think we hit that. Hit that. I think the question here is how long. The question here is, what it looks like right now is we have a Goldilocks scenario, and I think that's right. And what do we mean by Goldilocks? In a lot of ways, it looks like where we were in early 23, where inflation looked like it was coming down and growth is still fine, right? Totally fine. How long can we go through that process? And I think the answer is that we can go through that process for a period of time, in particular, while measured inflation moderates or is low and growth holds up. But the question is, can that persist without starting to create pressures in the bond market to go up, which is sort of the opposite of Goldilocks, or for where we're not seeing enough labor market deterioration or wage pressure moderation, so that when those disinflationary pressures start to fade, that we get inflation moving back clearly above the Fed's mandate. And so we could easily be in a circumstance here from the macroeconomic data standpoint where we see reasonable growth and low measured inflation that, you know, exists for 3 or 6 months, but that doesn't mean that that's the path, for instance, you know, starting in the spring and summer of next year, that's where we're going to go. And I think smart market participants are going to be starting to look ahead to say, they're going to start to look through those disinflationary impulses and start to see that we're going to have a dynamic where that may be reversing. I think that, combined with the fact that, at least in the bond market, we're likely to see a situation where the duration supply, which is by calendar wise quite modest in December, combined with the fact that we've had that rebalancing support, you put those two things together, we could easily see pressure on the bond yield, just as we saw in early 24 coming in early 23, coming again in early 24. There's a question here about which valuations, which measures were I considering when I was looking at these particular price pressures or these valuation measures here. What we look at here is the relative returns of the financial assets. And so you should expect over time the financial assets deliver a positive return, and more volatile financial assets deliver more return, and less volatile financial assets deliver less return. And so what we're doing here is on a volatility matched basis, looking across all the major asset classes and saying, what has their return level been relative to a long-term trend of what we'd expect for those assets to return. And that level of return is the thing that we're looking at when we're measuring what this looks like here. And so it's not a pure PE ratio, PEG ratio, or Schiller, or any of that stuff. It's just looking at the pure returns, the pure relative returns of the assets relative to their longer term norms. And so that could catch either, and I think this is why it's important, it could catch either that earnings themselves are overstated because margins are overstated, and that can certainly exist with equities, and or capturing the fact that PEs could be overstated as well. Let's just hit a couple more questions. I think one of these questions, which I think is a just more structurally interesting question, is how do you think about expressing contrarian views? The market certainly seems very highly convicted that there's going to be a lot of cuts. And what I'd say is that expressing contrarian views, well, first of all, the only way you generate alpha is by having a contrarian view. And so by definition, in order to generate differential returns, your view has to be different than the market. I don't know how many times I read something, for instance, just go read the 24 outlooks, the 2024 outlooks by many of the major sell side firms or buy side firms. And they'll say, well, we really think that the Fed is going to cut 150 basis points or 5 to 6 times in 2024. It's like, okay, so what? That I already know the answer to that. That's already in the market price. The question is, what's likely to transpire that's different from that? Where are the probabilities tilted different from that? And when you think about that, that's really what creates those contrarian opportunities, which is where are the probabilities out there in the market where the probabilities of certain outcomes are underpriced by the market. And so when you're thinking about how to position for that, I think the main thing to consider is not getting overweight on any particular bet. Any particular alpha decision can easily skew, 60-40, any one bet 60-40. And so when you're thinking about what do you put on, keep in mind that 60-40, that how good, think about your goodness, right? Which is, tilted in your favor, but by no means certain when you're putting on those bets. And so you want to remain conservative. There's good ways to create risk controls. I think many skilled investors use options because it helps contain a very clear amount of risk. You know exactly the risk that you're putting on the line. Or what you can do is measure those positions in VAR terms or expected or possible loss terms to make sure that you're not taking extreme views. I think the biggest thing when you're constructing a portfolio like this is to look across markets and try and find those opportunities where you can get a couple different bets on the market that are skewed in your favor, often or ideally bets that are negatively correlated to each other. Do you think in this cycle that markets will front run the economic cycle, or will they need to see economic damage to begin to price it? Well, I think in many ways, a lot of us have lived through only two, and a lot of us our most recent memories are two very acute cycles, which is 20 and 2008, both of which were highly V-shaped in terms of their dynamics, where there was an acute crisis point, markets sold off as a response to that acute crisis, and then easing occurred and markets rebound. And I think in a lot of ways that got folks to thinking that first crisis happens. You often hear people say first something breaks, and then the economy and markets respond. But that's not normally how macroeconomic cycles work. Most macroeconomic cycles are self-reinforcing, which is that the tightening of monetary policy leads to a weakening of asset prices. The weakening of asset prices leads to a slowing of demand. That slowing of demand leads to weakening asset prices, right? It's a reinforcing dynamic. And so what I'd expect to see through this cycle is that we're probably going to have to see some meaningful equity weakness before we start to get enough growth slowing to then start to create the recessionary dynamics, to then start to create the downturn. But that is going to be a reinforcing process, and it will continue until the point in which there's a sufficiently large easing, which can help reverse the economy. And we're not going to get to that, but my guess is that that's going to be tougher than most people expect. And so thinking about how will the markets play out, that timing dynamic, the timing dynamic will be bond yields or bonds underperform, stocks outperform, then stocks underperform and bonds outperform, and that stock underperformance is self-reinforcing. Another question here is, do you think that there's a chance the Fed will be more inclined to favor cuts in the first half rather than the second half, so they don't appear to be picking sides? There's sort of two different things. First of all, like the Fed responds to macroeconomic conditions. If macroeconomic conditions are aligned with tightening or maintaining policy, that's what they'll do. If they align with easing of policy, then they will ease policy. If you look back through time, the Fed has tightened monetary policy during election years many times. They've also eased monetary policy during election years. Certainly looks like, when you put that together, that election years and the political calendar is not a meaningful driver of the Fed's behavior through time. Could that be different this time? Hard to know. I'm not in the heads of the Fed, but it would certainly be against their core organizational mandate to operate in a way that would be responsive to electoral politics and the electoral calendar if there are meaningful macroeconomic pressures, either pushing them to ease or to tighten. I think I'll wrap it up with this last question, which is often the question is basically on the ordering. Why do stock declines need to happen? Why not just look past the recession that will come and just be long equities today? And the reason why that is because you have to have equity weakness in order to have, and when I say equity weakness, I mean company weakness, both through equity prices, but also through falling earnings in order to get the recession to occur. And the reason why that is because only when you have falling equity prices does demand slow, and only when you have falling earnings do labor markets weaken. And I think you could see that very directly, a smaller share of the economy, but you could see that very directly, which is, when did the tech layoffs start? The tech layoffs started when we saw tech stocks fall in 2022 substantially. The stocks fell, right? The response was to that, the stocks fell, the earnings fell, and the response to that was to increase their layoffs. Now, of course, that was only one small sector of the economy. It only represented 2.7 million people in terms of employment. It wasn't that big a deal on the macro level. But I think what it highlights is the ordering, which is, you don't get the sort of labor market deterioration until you get the point where stocks and earnings fall. And so just think about that dynamic when you're thinking about think about that case study when you're thinking about how this is likely to play out at the broader macroeconomic level. There's a lot of work to do. If we just take a step back on the overall economy, we're still running a secularly tight labor market. Nominal growth remains elevated relative to what's appropriate for the Fed's mandate. And despite the fact that, and on the margin, we have experienced a meaningful easing over the course of the last 4, 5, or 6 weeks. All that aligns with a stronger economy, not a weaker economy. And all that is inconsistent with the significant amount of interest rate cuts that are being priced into the short rate and the long end of the market, the bond market. And so when we look out to what 2024 will probably look like, my guess is we're going to see a real disappointment when it comes to meeting those incredibly high expectations for cuts. More than anything else, that's probably going to be the theme. In the same way, for bondholders, we had the biggest theme in 2023 was the cuts that were expected, particularly after SVB, didn't come to fruition at all. So that's probably, as we look out and think about the themes that are occurring in 2024, we'll get back together again in early January. I'm sure there'll be lots more to discuss there.